Well, hey there, everyone. Happy Friday, July 31st. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, wrapping up what ended up being a pretty bullish week as far as the major indexes are concerned. A lot of movement in the Dave's Dirty Dozen, those mega cap growth leadership names, with some gapping higher on strong earnings, some gapping lower on equally weak earnings. Amazon rallying pretty aggressively here on Friday, up about 15%. That's helping the consumer discretionary really lead the market higher to finish the week. Today, we're just going to do a brief check-in because we're recording this, just before the market close on Friday. We've got to get on the road and head up to a soccer tournament here shortly, but did want to get to the mailbag. I've got 6 questions coming from all of you guys in recent days, and I appreciate you asking some thoughtful questions. As a reminder, as we do the show live during the week, you are welcome to ask questions during the live stream at any time. Any of the questions we don't get to, we put in the mailbag. And also, if you watch this show later on our YouTube channel, we look at the comments section there and draw questions as well. So please keep them coming. All these questions came from people like you over the last week and makes the show pretty interactive, which is a lot of fun. Just checking in on the markets here, kind of, mid-afternoon on Friday. I mean, obviously, kind of a risk-on finish to the week. This is after Thursday having a pretty good up day. There was a lot of weakness earlier in the week. Wednesday, we're kind of testing that key support level. Our line in the sand of S&P 7,300 looks highly likely that the S&P will remain essentially in the middle of that range that we've been in all through June and July. So we end the month of July most likely in a fairly neutral footing, I would say, for the major indexes. I would say a lot of individual stocks and groups really differentiating themselves, and that's where we're continuing to focus our own attention. But major averages kind of pushing higher here. We had to digest kind of a Fed meeting and other things. So rates are pushing back to the upside as bonds sell off. So stocks are up, bonds are off so far on Friday. Metals weaker, crude oil stronger, soft commodities weaker today, and cryptocurrencies, essentially becoming disconnected a bit from stocks and showing quite a bit of weakness here as Bitcoin back down to around 63K. Interesting to note, again, market's not closed yet, but, certainly consumer discretionary doing quite well because of Amazon's strength. Communication services also looking pretty good on the downside. Materials down on some earnings-related news. We got neutral breadth. And the last thing I would say would just be big gains in a number of Mag 7 names, particularly Amazon and Alphabet, both having really strong performances on Friday. NVIDIA and Microsoft bouncing higher in the technology sector. And Apple, of course, really dropping after an earnings disappointment there. Apple had been, I would say, without a doubt, the strongest chart in the Magnificent Seven names. I don't know if it'll still have that moniker after this week is done. I'm going to review some of those charts over the weekend. But here's the chart of the S&P. And again, over the last, 8 weeks or so, we're literally right where we were in early May, right? Second week in May, we reached 7,500 for the first time. From that point to where we're at now, which is about 10 weeks later, we've literally just been oscillating above and below that equilibrium point. So 7,500 is kind of like the median of where we're at. Anything above 7,600, we would read as remarkably bullish. Anything below 7,300, I would read as significantly bearish, and anything in the middle is kind of neutral. And as a reminder, I think there are times when you want to be playing, or when I want to be playing the long side when we're in an uptrend. There's times when I want to be playing the short side when we're on the down, when we're going lower. And there's times when you want to sit on your hands and just wait, right? And I think this is one of those times where the indexes are certainly neutral. Are there charts with actionable setups, below and within those indexes? Absolutely. And so I don't think the money to be made right now is at the index level. It's more of a stock picking. It's more about a security selection exercise. And hopefully the tools and techniques we talk about on the show here give you some ideas about what sort of tools and techniques you can use. We're going to dig into a lot more of those themes over the weekend. Our weekly flight plan is our premium report only for our market misbehavior premium members. And if you've been watching the show and you find it interesting, the premium membership is like this, but way awesomer. Go to marketmisbehavior.com/premium for more info on the premium benefits, including our member community, those premium reports like our weekly flight plan and our monthly chart review, which we'll be putting out at the beginning of next week. This is going to be a really important one. And also a bunch of virtual courses you have access to as well. All right. Question number one. And again, thanks for all these questions. Please keep them coming. Can you show how you set up the yield curve chart with the S&P chart in log scale in the bottom panel? Yeah, I got this earlier this week and I kind of bookmarked it. Let me get this question off. Yeah, so the yield curve chart with the S&P, I think the one you're talking about is, where do I want to go? In my chart lists, I have this one called historical charts, and I was showing this one, yield curve with recessionary periods. I think it was this one. So these are the kind of charts, and I'll give a shout out to a number of people who are way better at stock charts than I am. One of my frequent viewers and a remarkably talented technical analyst in his own right, Dan Bird, often shares charts with me. And every time he shares a chart with me, I go, "Oh man, I am like an intermediate user at best. He's a power user." So there are a number of people that really know how to make this platform sing. I'm pretty good at it, I would say, humbly, but there are others that do well. And so charts like this, the basic charts are pretty easy to set up. The charts like this, which are a little more nuanced, take some effort, but I'll show you what I did. So there's a number of different things at work here. First off is, how do you chart the spread between two rates, right? So I'm doing the 10-year treasury yield minus the 2-year treasury yield. This is known as the 2s-10s spreads, pretty common ratio referred to in the financial industry because it basically is the shape of the yield curve. So if the spread between the two is wide, that means the 10-year is way above the 2-year. We have a normal shaped yield curve. If they're very similar, that means we have a flat yield curve. And if the 2-year is above the 10-year, meaning it's below zero here, that means it's an inverted yield curve. And those often have very important implications. So the way that you set that up is you literally run, ticker number 1 minus ticker number 2. And you can do that for a lot of things. It really only makes sense if you're comparing like interest rates or, things that are very similar. You wouldn't want to compare the price of one stock minus the price of another stock. It doesn't make a ton of sense, but you would maybe do a like a ratio chart or something. But if you're comparing two rates, ticker number 1 minus ticker number 2, that's the syntax you do it. And this is how you do it on stock charts. On other platforms, the syntax may be slightly different for sure, but that's how you do there. The way you add the S&P with the log scale on the bottom is you go down here and there's an indicator called price, and you want to put the ticker, and then you can do a comma and additional parameters. So if you do the ticker, comma, log, that'll make it a log scale. And a lot of people, if you don't, the problem is that uses an arithmetic scale. And it's not a great chart, particularly if you're looking longer term. This is a 20 or 30-year chart or something, right? So I'm going way back. It's actually 40 years as I'm looking at the chart. So, the problem is you really need a log scale chart because you want to be doing the y-axis on a percentage basis. So if you do the ticker, comma, LOG, that'll convert it to a log scale chart. That's one of those like hidden tricks. And so that's going to make the S&P chart look how I think you need it to look to really understand the percentage movements over time. And then on top of that, I also have like some annotations, and those are all under the annotation button. I'm using a series of vertical lines. I'm using some horizontal lines. And then these shaded areas, this is a Arthur Hill trick. He showed me this years ago. You basically pick a color and then bring the transparency up, right? And then you do that. And it's kind of like highlighting it. It's a great way to highlight a particular thing. That's a, kind of good stock charts trick. So that's how you do it, right? So, again, charts like this, I think it takes some effort to set up, but then once you do, they're really helpful to refer back to, and they're great reference pieces. And what this chart is specifically showing, if you missed the episode earlier this week, is when the yield curve is inverted, so the 2 years above the 10-year, and then we come back to a normal shape, which is what I've highlighted with the red vertical line. The recessionary periods usually come soon after, and the market usually sells off during a recession. The problem is recessions are not confirmed until months later, right? Because it's 2 straight quarters of lower GDP. And you can't really tell that until after it's happened, right? Because there's a lag to economic data. So, one of the best ways of identifying a recessionary period as it's happening is just note that if the yield curve goes inverted and then goes back normal shaped, that's what you want to look for. But that's how you set up that chart. Hope you found that helpful. All right, question number 2. What are your thoughts on the new price? It's a couple of stock charts questions, which are awesome. What are your thoughts on the new price comparison indicator performance spread? Any plans to add it to your charts to show relative strength? So, I don't know what the phrase is, the road to ruin is paved with good intentions or something like that. It's been on a list of things that I rarely get to, and I wish I did. I have that list. I'm sure you have that list too in your life. I have a bunch of things. I use a task management site called Asana. It's really helpful for capturing a bunch of things you want to do and or you think you need to do, and then helps you reprioritize and schedule stuff. And I couldn't run my business without having that sort of structure behind it because I'm by design kind of flighty and distractible. So it helps anchor me on where I need to be focusing my time and attention. Having said that, I have a bunch of things on like a rainy day list of like research things and things to dig into, new indicators and stuff like that. And if I don't show them quickly, it's just because I haven't gotten to it yet. You're referring to a really cool improvement. This is something I've been asking my developer friends at Stock Charts for a long time. And special thanks to the development team and certainly Grayson Rose, who helps keep them in line, because my recent conversations with them, I've certainly stressed, look, relative strength as measured by price performance is not great. And here's what that means, and not to get too geeked out on numbers for you, but this ratio of UNH versus the S&P, this is actually showing you the ratio of ticker 1 versus ticker 2. So I'm doing United Healthcare versus the S&P 500. And this is helpful because if the line is going up, that means United Healthcare is outperforming the S&P. I'm going to switch to like Apple, which has a little bit more movement. There we go. So if this line is going down, that means Apple's underperforming the S&P. If the line's going up, it's outperforming the S&P. Now, the numbers over here, to be honest with you, are relatively meaningless, and I'll tell you why. This number is basically saying from the beginning of this chart, which is about a year and a half ago, to the end of the chart, that ratio has basically gone up 3.3%. Now, does that mean if you bought Apple and would you have outperformed the S&P by 3.3% over that period? It actually does not, because that's a different math. That's actually percentage number 1 minus percentage number 2. So that's really more of a performance spread where you're looking at one return versus the other. And Stock Charts did not have that mathematically built into the system. So these percentages are not really they're not wrong. It's showing something that a lot of people probably don't understand, right? It's showing how a ratio has performed over time. As an investor, that doesn't really help you much because your returns would not be exactly that. Directionally, it's fine. And I don't tend to look at the percentages as much as I look at the direction of the line, which is why I don't worry too much about it. The same thing you could do like price and do symbol versus SPY. And this will show you the ratio itself is 0.41. That number doesn't matter, but you can see the line is doing the same thing. And so this is what a lot of technical analysts do, is just do the simple ratio. You don't care about the numbers. You're just looking at the direction of the relative performance, which is what's most important as a chart guy, right? That's what I'm looking for. However, again, thanks so much to my friends there, because they added this indicator, performance spread. And what that indicator does is what a lot of people probably thought the other indicator did, which is actually showing you what's your performance spread. So this is basically saying you actually need to say this is the syntax. So what you want to do is you say performance spread and just put the ticker of the benchmark you want to use. So now this is correctly showing you that if you bought Apple a year and a half ago, you would have outperformed the S&P by about 4%. And that number is kind of, live because the market's moving, but that is actually your performance spread. That's how much you would have, that's how much you would have beyond the benchmark for that period. So performance spread, on my list, on that list of things to get to, is to switch all of my charts to use the performance spread, because that's really what you want to be looking at. Now, all three of those things that I just showed you, if you're showing just a simple ratio chart, if you're doing the price performance indicator and showing the ratio and showing between the two, or if you're using performance spread, the lines are identical, because the only thing that's changing is basically the calculation of the y-axis, the calculation values, but all three of them have the same visual presentation. And so for me as a technical analyst, that's why I'm not making it a much of a higher priority, because I can already see what I need to see just from any of those. But in terms of actually making this y-axis make sense, you want to use the indicator called performance spread and add the benchmark there under parameters. I hope that made sense. That might have been a little wordy or confusing if you're not familiar with return analysis, but this is something, back in my days working as an institutional investor for a large buy side firm, we would spend a lot of time, thinking about relative performance and different ways to measure it. So we had all sorts of even more exotic ways of breaking those things down. But that's what those indicators mean. And yeah, performance spread is the one to use on stock charts now, and use that syntax. Great question. Next one. What do you make of the reaction in the U.S. 2-year versus 30-year yields following the FOMC? That was actually a really interesting question. And what I would say, the short answer is there's been a lot of movement. And I should point out, you asked a number of other, it was a much longer question that you shared. The dollar dropped sharply, gold rallied, after the Fed. Does that mean the bond market doesn't believe Warsh is able or willing to hike rates, and therefore higher inflation for longer is the expectation? That was sort of the longer question that you asked. So a couple thoughts on this, right? So number one, right? So that when you're thinking of a couple things to tell you about. So what you're talking about, and I'm showing the 210 spread. You're basically talking about like the 2s 30s spread, which I don't really look at a whole lot. I look at the 2 and 10-year spread and the 3-month to 10-year spread, which kind of get to the same thing that you're mentioning. That spread kind of came in a bit. So and then what's interesting is, since you asked your question, then since the Fed, the 2-year and the 10-year have both rotated higher, and the spread is actually back to pushing to the upside, right? All of those spreads that we just talked about are widening back out here going into the weekend. So what does this all represent, right? So a couple thoughts on this, right? So number one, we can't talk too many long-term, takeaways from what just happened on Wednesday, and in that, 90 minutes after the Fed meeting and during the Fed press conference, because what you have to remember is there's been a longer trend of the dollar generally going higher. Let me bring up this chart. So the dollar index has been relatively strong, but just in the last couple sessions has started to break down. Gold, which is here at the bottom, has been relatively flat, and certainly over the last 6 months has been generally going down. So the trend kind of post-Fed is weaker dollar, kind of stable gold, and crude oil prices kind of chopping around as well. So I would say still unclear as to what the longer trends will be, which would really speak to some broader, I think you can draw broader conclusions from broader amounts of data, right? I don't want to read too much into short-term movements. The dollar, as I mentioned earlier in the week, I've heard some comments that the weaker dollar could be tied to manipulation by the Japanese, central bank, sort of toying with the yen and basically trying to boost the weaker yen, and that would mean the dollar is weakening versus the yen and other currencies, and so that's part of what could be part of what's reflected here on the chart. But I would say in terms of rates, right? Here's a way to think about it. The shape of the yield curve is important. We looked at that spread earlier, so I would say generally the yield curve has been widening, or has been steepening, I should say, over the last month. And I would say even with the hiccup in the last couple of weeks, finishing the week sort of at the steepest point that it's been since late January or June. So I think that's one thing to take away. Rates are generally going higher, and so I would say, at this point, if you would see the dollar go down, if you would see gold starting to break out, if you would see the 10-year yield kind of staying strong, if not going higher. I mean, for me, that combination of things would kind of imply expectations for inflation and concerns that inflation becomes a bigger deal would be my general way of taking that. Latest inflation data came in, kind of less than expected. So we haven't really seen any significant data, but we also have to remember that with the conflict in the Middle East, commodity prices have popped higher. So, energy related prices have certainly popped higher, or at least that part of inflation appears to be an ongoing issue. So I would say that's part of it. The other thing I would say, and this is something to keep in mind, is the 2-year yield is actually really the one you want to pay attention to when you're thinking about expectations for the Fed. And this was a chart it's based on a chart that Tom McClellan showed me years ago, which was basically, tracking the 2-year yield versus the Fed rate. And this is, in black is the 2-year Treasury yield, in red is the Fed funds target rate. And if you look, pretty much 100% of the time when rates have been low, before rates start to go higher, but then the Fed fund target rate starts to go higher, the 2-year yield starts to rise. when the Fed has been going higher, when the target rate has been going up, the 2-year yield almost always breaks down before the Fed stops raising rates and before the Fed starts lowering rates. So the 2-year yield has actually been trending higher for most of 2026, even though the Fed has been keeping rates relatively low. So the 2-year yield is telling you, based on this historical analysis, that Fed's basically getting ready, and there's often like a 6-month lag between the 2-year yield rallying and the Fed starting to raise rates. That lines up pretty well with the Fed starting to raise rates at the September meeting, which is what the market's currently pricing in. So, basically, I would not say those combination of factors imply the Fed is going to be less willing and able to raise rates. To the contrary, the fact that 3 or 4 of the governors voted to raise rates at this meeting, and given what the market is pricing in, it sounds like rate hikes are going to start here pretty soon. The 2-year yield is telling you that's a clear expectation that would make sense. The challenge right now is if the 2-year yield goes up, as long as the longer yields go up, the yield curve remains kind of normal. But if the Fed starts raising rates and the 2-year yield keeps going higher and long-term rates come down, that's where we get an inverted yield curve. That would imply a lot of concerns about future economic growth. So that was a long-winded run through some of those things, but that's what I would. Those are some of my takeaways just from the meeting this week. And again, I wouldn't read too much into gold popping because it did pop on Wednesday, but I would say still the chart of gold is still neutral at best and still below key trend lines and key moving averages. So I don't think that's really shown the strength that you may want to see just yet. All right. Got a couple more questions to go through very quickly, but before we do, I just want to let you know, had a really fun live stream yesterday with Vince Randazzo and Ryan Gorman of Tamarisk Capital Management. They're 2 knowledgeable market practitioners, talked about creating system design, testing systems, different inputs and how to think of those, and really drawing on their own experience developing the systems that they now use to run a new ETF, which was launched earlier this year, called the Defender Risk Adaptive 500 ETF. So we talk about using systems to manage risk, what happens when you don't trust your system, anxiety related to it, all of that and more, with some great anecdotes about investing in system design. You can find that on my YouTube channel, by the way. It was a great discussion earlier this week. Thanks again to Vince and Ryan joining me for that live stream. That was a lot of fun. All right, 3 more questions and we'll call it a week here. For materials and industrials, which one do you consider more of a barometer of the U.S. economy? And do you think the stock market takes cues from one or the other more? That's a really interesting question. So questions like that, I love to refer back to a fabulous visualization on stock charts. If you go to, where is this? Charts and tools, and then go to dynamic. Nope, that's not what I wanted. I wanted sector. Yep, market analysis. Oh man, where is this? Charts and tools. Oh no, where did it go? I think it's gone. Hold on, I need to find it. There's a thing called the sector performance chart. Oh man, I have no idea where this is now. Sector. Here it is. Found it. Sector perf chart. That was buried. Okay. The way I found that, I don't know why it's not on this main thing, but if you click charts and tools, go to all tools. Oh no. So sorry, go to market analysis. Oh, there it is. I just missed it. Market analysis sector perf chart. Wow. Folks, I need the weekend. I apologize for that. All right. And then scroll down a little bit. There's this, sort of idealized model. This came from work by Sam Stovall, who I've had on my podcast before. Sam's awesome. Our mutual friend, Ralph Eckenporta, introduced us years ago, and Sam's a fantastic market strategist. He's at CFRA Research, but spent a number of years at Standard & Poor's as their chief strategist. And he kind of created this visualization, which speaks to leadership during different market cycles. So couple observations here before I answer your question. Number one, the orange is kind of the idealized market cycle. The blue is the idealized economic cycle. And remember, it doesn't always go exactly like this. These are idealized cycles. There's always a lot of, uniqueness to every market cycle, but these are some generalities that I think have stood the test of time. So if you think about it, number one, the market cycle leads the economic cycle, right? So the stock market is one of the best leading indicators for the economy. When the stock market is strong, that means investors are pricing in stronger economic growth. The market almost always turns lower before the economic data really peaks, which catches people a lot of times off guard. Like, how's the market selling off when the economy is so strong? That's actually remarkably common because the stock market, again, is based on forward-looking expectations. So if you see your earnings starting to go down, if you see economic challenges going forward, you start, excuse me, selling stocks today. So that's why the market usually leads the economy. So in the early leadership out of the lows, some of the growth sectors usually lead. Technology, consumer discretionary, communication services are generally those early leadership sectors. Then you have what are called like the late cycle leadership, and it's the MEI stocks: materials, energy, and industrials. And energy usually comes kind of at the later part of that. So when energy starts to outperform, that's always a bit of a warning sign, because that is, the stuff that tends to lead when when the markets get to a top. And the reason is because those are the things that tend to benefit. Those are cyclical sectors that tend to do well when the economy is growing, right? So when the economy is in sort of a recovery period, that's when those cyclical sectors, those value sectors, tend to do well. Then the stock market rolls off. Investors get defensive into things like consumer staples and healthcare as the market's rolling over, but the economic data is usually still pretty strong. And then when the market rolls over, defensive sectors start to do the best. And that's kind of based on a lot of different market cycles and what happens. So I don't know if I would really differentiate much between industrials and materials, because in my opinion, they're both kind of in that cyclical leadership. Is why we call them the MEI stocks, right? Materials, energy, and industrials. They often will kind of move together because they're the types of stocks that tend to do well when the economy is growing. Basic materials, the industrials, the companies doing stuff with all the raw materials. That kind of makes sense that they would move in a similar time frame. So do I think of one of them as more of like a leading indicator than the other? I probably wouldn't. I would generally say when you see industrials and materials kind of all clicking, that tells me market strong, economy strong is generally the combination of things you're thinking about, which means you always want to be watching for energy, and then staples, utilities, some of the late cycle and then defensive sectors. When those start to do well, that's when you want to start to be concerned, because that often is lining up with the market top. And the economic data would still be strong at that point, even when those sectors start to do well. All right, Dave, do you ever use the volume profile indicator? I mean, the fact that you've probably never seen it on the channel means probably answers your question, but I get maybe I'll paraphrase, like, why don't you use it? And that's a fair question. So the volume profile, right? So there's different indicators you can kind of overlay, and different charting platforms call this something different. On stock charts, it's here under overlays. They have an indicator called volume by price, and it kind of looks like this. So they show it on the right axis like this. Different platforms I've seen do different ways. Like on Bloomberg, we overlaid it on the left side when I was there. I mean, whatever. No, I don't use these a lot. I mean, what this is basically trying to tell you, this is based, I would argue, on work by Pete Stottlemyre, who is a kind of a famous educator, trader based in Chicago. I never met Pete, but worked closely at times in my career with Robin Mesh, who was one of Pete's kind of proteges, and learned from him, and wrote some books of her own. Actually wrote a chapter from my book that was published, yikes, almost 20 years ago on using market profile, which is a visualization that Pete Stottlemyre created. The idea of this is you can look at distribution over a period of time, right? And you have a look back period, and a normal environment, we should be making kind of a bell curve with the price action. And again, it happens in different periods. And then, once you kind of set the initial range, you often will fill out the distribution to make more of a normal bell curve shape before the market kind of moves in a new direction. That's kind of the general juge of this sort of thing. And now the idea, now how do you use it? I would say, just like you would use support and resistance, areas of heavy volume concentration usually means we've spent a lot of time there. Those should be kind of higher conviction support and resistance levels, right? It's a way to see where has a lot of the volume been concentrated at the price level. And then the idea is those areas of heavier volume would probably be important pivot points to keep in mind. That's where we would often have, support and resistance to be confirmed. Honestly, I don't use a lot of volume indicators in my work anymore. Earlier in my career, I definitely did. That's been, when I get the question in like a podcast, what's changed in your toolkit from when you learned it? I always say I used to use volume a lot more than I do now. I used to use money flows and other indicators that were very popular kind of in the mid late 90s. And a lot of them just became less effective, I would argue, in the 2000s, in the 2000 teens. Part of that was just the change in market structure and decentralization of trading. A lot of that's changed, I think, what the volume data represents. So no, the short answer is I don't use that indicator a lot. Are there people that use it and swear by it? Absolutely. And Robin comes to mind as someone who does a great job of sort of illustrating those distributions and what they might represent. Noting to myself, maybe I could get someone on the podcast who focuses on that type of profile work, volume work. I'll see what I can find out. If any of you have any suggestions of someone where you've seen that they use those techniques and seem to have success with it, let me know. I'm happy to reach out to them, see if I can get them on the podcast and dig into their process a bit. All right, final question. Can the performance of the SpaceX IPO give us any insight into upcoming IPOs like Anthropic, OpenAI, or Databricks? Man, I tell you what. So the short answer is sure. I think you could a little bit. By the way, latest episode of the Market Misbehavior podcast, I had a really good discussion with Joanne Bianco. That episode just went live earlier today on Friday. I also have another episode with my editor, with Mary Ellen McGonigal, that'll probably come to your way over the weekend. It might come out like Monday morning. We'll see when we can get it out to all of you. But I asked Mary Ellen a very similar version of this question. Just, talk us through your experience with the SpaceX IPO, how you approach IPOs like that. And I thought she had a really good question with that. Now, what Mary Ellen mentioned, I'll let her give you her full answer, but the way I would tell you is the SpaceX IPO, as this was coming out, as it was being priced, as it first started trading, I couldn't stop thinking that it reminded me a lot of the Facebook IPO, which is the last kind of IPO of this size where there was such an expectation. I mean, they did the road show where Zuckerberg and team are going around to different big investment shops. He came into the firm I worked and we met with them. And I remember going through and thinking, like, this is huge. Like, there was so much anticipation for this IPO. Now, again, what was so funny is it was obviously a great company and potential for great things, but they were making no money on mobile. They hadn't monetized the mobile app yet. That's where they were at in their trajectory as a company. So there's a lot of questions like, how are you going to make money on mobile and stuff like that? And what happened on Facebook's IPO, if you go back to the history, is you had this big, IPO priced, big spike, and then it absolutely tanked. And it took forever before Facebook actually was above its IPO price, until it actually went above that first traded level. I mean, it took a while. And so that is my, sort of back of my mind. The reason why that can happen is because when an IPO happens and there's such anticipation, it's usually way oversubscribed, which it was. It usually gets priced pretty high, which it was. And then the moment people that were not able to participate in the IPO actually are able to get into it, the price spikes very quickly. And that's what happened for 3 days. Price spiked aggressively. Then all of a sudden that initial euphoria wears off. And then you have to start thinking about, what am I paying for if I buy a share of SpaceX right now? And is that reasonable based on, potential earnings growth and the valuation now versus what I'm expecting years down the road? And so what's happened afterwards is the same exact thing that happened with Facebook, which is the price deteriorates pretty aggressively when the price can't support expectations that are just not fully formed yet, right? Or not realized yet. Will SpaceX eventually be one of the great stocks we have to follow? I could see that being a very likely scenario, right? If my runway's long enough, picking up some SpaceX now, I don't mind that idea. I don't own any SpaceX. I'm thinking I might pick some up now that it's down to $110 a share. But again, this is a long-term play, right? If you could go back in time and buy Meta after the big drop after its IPO, seems like a pretty good bet right about now. So as a long-term play, when your runway is long enough, I think it makes a ton of sense. In the short term, is the chart telling you anything besides this is a stock in distribution and then investors really are not buying into it? No, I don't see anything refuting that basic premise. So from a technical perspective, I would say impossible, in my opinion, to justify this particular stock at this particular moment. Again, as a long-term speculative play and taking a bit of it now, with the expectation that eventually all these earnings and expectations are fully realized, I think that makes a ton of sense. But again, I am not surprised in the least that the early chart of SpaceX looks a lot like the early chart of a publicly traded Facebook. Folks, that'll do it. I got to get on the road and get up to Northwest Washington State. I wish you guys a wonderful weekend. Thanks for following my work. Thanks for asking these awesome questions. Have an enjoyable weekend. And as always, remember, it's always a good time to own good charts. We'll see you on Monday. Take care, folks.